Hey guys, happy Tuesday. Welcome back. You guys might have seen this in After Hours, a press release saying that S&P cut AMC's credit rating to selective default following the debt deal that was announced on Monday. In this video, we're going to talk about Red Lobster, but also we're going to talk about the S&P credit report. I pulled up the details. I want to go through it with you and share with you what S&P thinks of this debt deal. Let's get right into it. All right, let's talk about this credit report from S&P Global. You guys probably know there are two main credit reporting agencies for public corporations, S&P Global and Moody's. I think Moody's will probably issue an update in the next day or so, but we got the one from S&P today, so let's talk about that. But before we read through this and see what they have to say, I just want to address the Red Lobster. For those of you that were paying attention on the thumbnail, why was that there? We have some of our friends in this play that are comparing AMC to Red Lobster. And I'm not going to go into the whole Red Lobster story, but let's address the specific concern being brought up. Donahue did DM me this morning with a couple questions. I answered his questions. We had a little conversation back and forth, and I appreciate having conversations with you guys when you have questions. But he put out this video this morning that said, is AMC new debt deal Red Lobster 2.0? AMC gave up ownership of the AMC name and IP plus 175 theaters. So I wanted to share with you guys exactly what I told him and my thoughts, my opinions on this question after having read through most of these documents that got filed yesterday. We will see more about this in just a minute when we go through the S&P credit report, but I want to share with you guys what I shared with Donnie this morning when we're talking about this asset transfer agreement. And you guys know that as part of the deal yesterday, AMC transferred some of its assets, its IP, its copyrights to a new company called Movico, M-U-V-I-C-O. Because what the asset transfer agreement says here in green, the second half of this sentence is that Movico is a wholly owned subsidiary of Centertainment. And right before that, it says that Centertainment is a wholly owned subsidiary of AMC. And I want to show you guys where to confirm that if you'd like to. Just go to the most recent AMC 10K down at the very bottom where all of these hyperlinks are to other documents. And they have a list of subsidiaries of AMC. And there are a bunch of them here, including, as you can see, Centertainment Development Inc. Movico is not in this list because it is a new legal entity domiciled here in Texas. I'll put a link up on the screen where you can see the LLC registration date was in May. So at some point in the future, when we get an update on this list, you will see Movico added to the list. Basically, what we have here in a nutshell is AMC transferred assets from itself to itself and isolated them in a new legal entity, that subsidiary Movico. They did not give up these assets. It's all still under the parent company. And the documentation is here for you guys to go read. Hopefully this is enough for you to agree AMC did not give up the ownership of all of these assets. And if that is not good enough for you, then just carry on believing whatever you guys would like to believe. And we'll see how it all works out in the end. Now, to be clear, these assets are pledged as collateral to the new loans, but they were pledged as collateral for the old loans too. You guys get that, right? AMC's assets are pledged as collateral for the debt that AMC has. It doesn't really matter whether it's in this bucket or that bucket. If the company were to go bankrupt, we're not going to get anything anyways. I don't care which bucket it's in, we're all screwed. Is AMC going to go bankrupt? That's really the question you got to ask yourself. Why are you invested in it if you think that it is? And let's throw up this chart here on the screen and look at the last year's bond performance on the 5 3/4% bonds, which were trading at $50 and now are at $95, almost at par. If you guys know anything about bonds, they sell off when the bondholders think the company is at risk of default, at risk of going under. And this long trend up, almost back to par, certainly tells us the opposite story. You want to look at the bond market to figure out what is the company's risk of bankruptcy, because they're going to be the first ones exiting the play. And all we see here is the bond prices going up, indicating to us that the bondholders feel at this point there is almost no risk of bankruptcy for AMC. Now, I know we got our haters on the other YouTube channels. We got our trolls and our conspiracy theorists that are convinced this company is going bankrupt. I would ask any of them to explain this bond chart. Go ask them to explain this bond chart and then defend their position. Right now, the bond market is telling us very low risk of bankruptcy. Ultimately, guys, it's going to come down to box office, revenue, earnings, and cash flow. So now that this debt restructuring deal is behind us, those are the next things as investors in AMC that we need to focus on: box office, revenue, cash flow, and earnings. I know there's a lot of people crapping on the box office right now because it seems low, but I don't think that they understand the movies that are coming out the remainder of this quarter or the remainder of this year. And those of you that are actually following this company closely and upcoming movies, you know the deal. Stick around and we'll all find out together. Most of those people throwing shade on the box office don't follow the movie industry closely. They don't know what movies are coming up. And let's be honest, none of them are very good at forecasting earnings for the companies that they do follow, that they're invested in. So I'm certainly not going to take box office advice from those people. All right, moving over to the credit report from S&P, the SD or Selective Default Rating. You guys have seen this before if you've paid attention to the channel. Every time AMC or any company does a debt restructuring, the credit agencies throw this temporary notation on the account, selective default or limited default if it's Moody's. That will stay on there a couple weeks and then they will remove it. And it goes back to the old credit rating, which for AMC at the moment is CCC plus, I believe. SD rating is just a formality that they do whenever a debt restructuring takes place, so I'm not worried about this. We've seen this many times over the past couple years with AMC, every time they do some sort of debt restructuring. Later this week, I plan to do a 5 or 10 minute recap of the deal that AMC announced on Monday. I was hoping that Adam Aaron would explain it to us in simple terms that we could all understand this morning when he was on Joe Kernan's show. But what did he tell us? Go read the filings. Yeah. Where have you heard that before? And that is what I'm doing. I'm reading the filings and making sure that I really understand them as much as possible before I put that summary video together. But we got some hints here from S&P Global, so let's talk about what they say. The top part of this first paragraph says the same boilerplate language that is there every time they do a SD rating for a couple weeks. But they did add one little bit of new info here relative to this most recent deal. The transaction strips collateral coverage from AMC secured notes due 2029. I have that highlighted in yellow on your screen there. The remaining second lien notes that were not repaid, I have that highlighted in blue, and any portion of the pre-existing term loan that is not exchanged, which is highlighted in green. Remember, with the blue and the green, those are the ones that AMC is restructuring as part of this deal. But the deal is what I called yesterday on the live stream, more of like a framework right now. They have the framework to pay off all of this debt with the restructuring deal, and they are knocking some chunks out of it, and they have the option to knock other chunks out of it. But it's not a fully completed deal yet because AMC is going to be patient and try and use those options, the ors and the ifs, to pay off the remaining part of those debt that is in green and blue, maybe at a later date. So this is a work in progress. They've got the framework in to knock it all out, but as S&P is noting here, some of it at the moment is still holding in the old debt structure. They go on to say that the new transaction from yesterday created a new subsidiary, MovieCo, that does not guarantee any of the company's previously existing capital structure, those blue and green and yellow that I just showed you on the screen there, that old debt. The company will transfer theater assets and AMC IP to the new subsidiary as collateral to support the new debt. In our view, this would effectively subordinate non-participating lenders with respect to the assets held at the new subsidiary, encouraging participation. So now you can kind of get a feel for why AMC set up MovieCo to encourage anybody who is holding that old debt to move to the new debt. Remember the ors, the ifs, the framework is there. Now the encouragement is there. Hey, if you want your debt collateralized, why don't you take this new debt deal? Make no mistake, part of the deal is in place, but they are encouraging everybody to get on board with the new plan. And they talk about this here in the next paragraph that I have highlighted in green. The transaction will include a new term loan of between 1.2 and 2 billion, subject to the percentage of existing term loan lenders who opt in, and 414 million of new exchangeable notes. In addition to the second lien note repayment, the company will also exchange between 1.1 billion and 1.9 billion of its previously existing term loan for the new term loan at the newly formed subsidiary. Non-participating lenders will not have a claim against the assets held at the new subsidiary and would have substantially all of their restrictive covenants removed. Again, this is just saying that AMC creatively set up this new entity, MovieCo, this subsidiary of the parent AMC, to encourage all of the lenders to get on board with the new loan program. Wow. The transaction significantly reduces AMC's 2026 debt maturities, but does not improve the company's ability to generate free operating cash flow. In total, the transaction will reduce debt due in 2026 by between 1.6 and 2.4 billion. However, the company would still have 300 to 500 million of debt due in 2026 to address. Our base case assumes the 414 million of new exchangeable notes would be converted to equity in the near term, but the interest expense savings from this conversion would be more than offset by the increase in pricing for the new term loan. All right, let me break that down for you. I think you guys all know, hopefully, that AMC has that big 1.9 billion term loan that is due in 2026. And then they have that 10%, 12% PIK toggle, which is in the neighborhood of 700 some odd million dollars. And those are the two pieces of the debt that they are attacking with this new deal. The 10-12 PIK toggle, that interest rate got reduced. And on the new deal, the term loan interest rate went up slightly, but it is a adjustable rate. And basically what S&P is telling us here is you got a interest rate reduction over here. You got an interest rate increase over here. So the quarterly interest that the company pays, they expect to probably remain about the same with the new deal. And therefore, they're saying that this new deal in their current calculation is not expected to improve the company's ability to generate free operating cash flow. The deal's not quite all the way done yet, as we just went through in the preceding paragraphs. So we will all have to pay attention to how it all works out over the next couple quarters and see which lenders get on board, what interest rates do. And this story could change on how the new deal affects the free operating cash flow. I don't want to skip over this part that I highlighted in yellow. They say that our base case assumes that the $414 million of new exchangeable notes would be converted to equity in the near term. That is, if you hear people talking about dilution or those 92 million shares of potential dilution, S&P is saying that their base case, the way they're looking at it right now, is that some point in the near term, is their words, they expect that those will be converted to shares. So that is something that you need to keep in mind as an investor as you're deciding what to do. Obviously, that is more shares in the float, but it wipes the debt off the balance sheet. They close out by saying, we plan to reevaluate our credit rating for AMC within the next several months to reflect the company's new capital structure and liquidity position. Our review will focus on the long-term viability of AMC's capital structure, its performance, and our forward-looking opinion of its credit worthiness. And if you're bullish like me on box office and the guest that we had on the live stream last night, our guess is right now, our opinion is that there is a potential for a credit rating upgrade. That is going to depend on box office performance. So guys, go see a movie. I have kept you long enough. Hopefully you found this helpful. Thank you for watching. I am Tony Denaro, and I will see ya on the next video.